In 1955, the average American family could buy a house for less than 3 times its annual income. Today, that ratio exceeds 8. Yet wages have barely doubled, while home prices have multiplied tenfold. Something fundamental changed, and not by accident. After World War II, governments rewired the economy around ownership. Mortgages became the fuel of prosperity. Banks multiplied credit. States guaranteed it. Entire generations learned that debt was safety, and that a house was not shelter but proof of belonging. It worked, for a while. By the 1970s, the average mortgage rate was below 5%. Suburban land was abundant. Construction costs were stable. But behind the facade of middle-class comfort, a silent transfer was taking place. Wealth was moving not from poor to rich, but from future to past. Every dollar borrowed against a house today promised a dollar taken from tomorrow's buyers. And now imagine a system where every policy, every incentive, every dream was designed to raise the value of an asset that already existed. Inflation became policy. Zoning froze supply. Credit expanded demand. Prices soared, and so did the illusion of growth. The more people paid for homes, the richer the previous owners became, without lifting a brick. The coincidence is too precise to be accidental. When central banks cut rates, home prices rose. When prices rose, voters felt wealthy. When voters felt wealthy, politicians stayed in power. It was a perfect feedback loop, until the next generation arrived and found the door locked. Today, owning a home has turned from a life stage into a luxury brand. The rules didn't vanish, they calcified. We inherited not property, but policy, a structure that rewards yesterday's debt and punishes tomorrow's effort. And the paradox is clear. What once built the middle class now quietly dismantles it. After the war, the Western world faced a paradox: enormous wealth and enormous fear. Cities were growing, soldiers were returning, and governments had a promise to keep: stability through prosperity. The solution was not philosophical, it was architectural. Build homes, build confidence, build the new middle class. Between 1945 and 1965, millions of houses rose from empty fields. In the United States, it was Levittown. In Britain, the new towns. In Australia, the quarter-acre dream. Mortgages became the social contract. The bank was no longer a distant institution. It was the invisible partner in every living room. The numbers are astonishing. In 1950, fewer than half of Americans owned their homes. By 1970, nearly 65% did. Credit, once a privilege for the wealthy, was repackaged as patriotism. Buy now, pay later became not just a slogan but an ethic. Debt was no longer shameful. It was the language of modern life. Governments quietly built the machinery. The U.S. created the Federal Housing Administration, the GI Bill, and Fannie Mae. Britain guaranteed council-built mortgages. Canada launched the CMHC. These agencies didn't construct houses. They constructed belief. By ensuring loans and backstopping banks, they converted paper promises into concrete walls. Risk vanished, or so it seemed. Money flowed like water, but it was not evenly distributed. Suburban landowners prospered, urban renters stagnated. Banks discovered a simple truth: the safest borrower was the one already holding an appreciating asset. Credit, therefore, chased collateral. The result was self-fulfilling. Prices rose because lending increased, and lending increased because prices rose. Some historians believe this was the moment capitalism quietly pivoted from production to appreciation. Manufacturing profits slowed, property gains accelerated. A new hierarchy appeared, not between classes, but between generations. Those who bought early owned the escalator. Those born later ran beside it. In macroeconomic terms, this shift looked benign. GDP climbed, employment was steady, inflation modest. But under the surface, leverage deepened. Household debt in advanced economies grew from 25% of GDP in 1950 to more than 60% by 1980. The engine of post-war growth was not income. It was obligation. And yet, it felt stable. Mortgage payments were predictable. House prices rarely fell. For the first time in modern history, ordinary citizens could build wealth without producing anything new. Their asset appreciated simply by existing. The state protected it, banks amplified it, and culture sanctified it. Homeownership became the moral center of democracy, proof that the system worked. But systems built on certainty tend to ignore volatility. The idea that housing prices could fall became unthinkable, which made it inevitable. Each policy meant to support ownership, tax deductions, zoning restrictions, fixed-rate subsidies, added another layer of rigidity. When the global economy began to change, housing could no longer adapt. By the late 1970s, inflation surged, interest rates spiked, and the first cracks appeared in the dream. The same instruments that had created the middle class now threatened to suffocate it. The mortgage, once liberation, became a leash. And the most revealing fact? The system didn't fail because it was unfair. It failed because it succeeded too well. By the late 1970s, something broke. Quietly, almost politely. The numbers no longer aligned. Wages rose, but prices rose faster. Interest rates climbed into double digits. The dream of universal ownership, once self-sustaining, began to consume itself. In the United States, a typical 30-year mortgage rate in 1981 exceeded 18%. Britain saw similar spikes. For a generation that had grown used to cheap credit, it was a shock. Monthly payments doubled. Buyers vanished. Construction froze. For the first time since the Depression, housing was not a ladder. It was a trap. What caused it? Not one single failure, but a chain reaction. Oil crises in 1973 and 1979 shattered the illusion of infinite growth. Governments printed money to soften the blow. Inflation surged. Central banks fought back with higher rates. Every action to protect the currency made homes less affordable. The coincidence is too precise to ignore. In the post-war decades, prosperity had been built on expanding credit, but when credit became expensive, the illusion of wealth evaporated. The entire architecture of the housing economy, from savings banks to building societies, depended on one assumption: that tomorrow's borrower would always pay more than today's. When that stopped, the structure trembled. Developers halted projects mid-foundation. Governments that had guaranteed loans found themselves owning ghost neighborhoods. Millions of families faced a cruel irony. They had assets on paper, but liabilities in reality. Their homes were worth less than the debt attached to them. And beneath the statistics, something deeper shifted: trust. For decades, citizens had believed that homeownership was a one-way street towards security. Now they saw its reverse: volatility, fragility, exposure. A house was not just shelter, it was a leveraged bet on national stability. In Britain, the right-to-buy policy of the 1980s privatized millions of council homes. It was sold as empowerment, and for many, it was. But each sale removed one unit from the social safety net. Each family became an investor, dependent on rising prices to stay afloat. Collective security gave way to individual speculation. Across the Atlantic, the Reagan administration deregulated the financial sector. Savings and loan institutions, once slow, cautious lenders, were unleashed into the open market. They began trading mortgage-backed securities, slicing and selling the very debt they issued. Housing had transformed from an asset into a product. It could now be packaged, sold, and bet upon. And now imagine the same house generating profit 3 times, once for the builder, once for the bank, once for the speculator. Money multiplied, but homes did not. The financial layer expanded, the physical one stayed still. The result was inevitable: scarcity in reality, abundance on paper. Some economists warned of the danger. Charles Kimballberger in 1978 described the mania for property as the modern version of the tulip bubble. Others dismissed it. How could a home, a necessity, ever lose value? But the logic was already poisoned. If debt created wealth, then more debt must create more wealth. The line between affordability and profit blurred. By the end of the 1980s, the gap between income and housing cost had become a chasm. Young adults delayed marriage, children, independence. The starter home became myth. Ownership aged, literally. The median homeowner was now over 40, a decade older than a generation before. The ladder still existed, but its first rung had been sawed off. And yet, policymakers called it stability. Prices rising slowly, construction controlled, wealth preserved. But for whom? The illusion of stability concealed a quiet inversion. The system no longer served those entering it, only those already inside. The problem, therefore, was not the crash. It was the normalization of imbalance. A society built on the promise of opportunity had locked that opportunity inside real estate deeds. And as interest rates fell again in the 1990s, the cycle restarted, only deeper, faster, and riskier. What appeared as recovery was, in truth, repetition. If this revealed something you hadn't noticed before, let me know where you're watching from. To understand how the dream turned into a trap, we need to look at the machinery itself, the invisible gears that transformed homes into financial instruments. Because nothing collapsed by chance. It was engineered to work exactly as it did. At its core, the modern housing system runs on leverage, borrowed money amplifying both profit and loss. When a bank issues a mortgage, it doesn't lend existing deposits. It creates new money secured by the promise of future repayment. In accounting terms, every home loan is a small act of monetary creation. Debt becomes currency, property becomes collateral. The circle closes itself. During the 1980s and 1990s, this process evolved into an industry. Mortgages were no longer just agreements between families and banks. They were raw material. Financial institutions discovered they could bundle thousands of loans together, turning them into securities, mortgage-backed bonds. These bonds were sold to investors around the world who received interest payments as if they, too, were miniature landlords. It was elegant. It was dangerous. Because risk, once local and visible, became abstract and global. A missed payment in Ohio could ripple through pension funds in London or municipal budgets in Tokyo. Housing had merged with finance. Shelter had merged with speculation. Credit agencies labeled the bonds safe, governments encouraged homeownership, and central banks kept interest rates low. Money was cheap, so prices rose. Prices rose, so collateral expanded. Banks lent even more. The loop tightened. Each participant acted rationally, yet the collective outcome was irrational. Exponential price inflation without equivalent productivity. And now imagine a system where every incentive pushes in one direction, up. Homeowners want higher values. Banks want larger loans. Governments want content voters. Investors want stable yields. Nobody has an interest in stability if appreciation pays more. Growth became the only acceptable condition, even when it meant distortion. Zoning and regulation joined the cycle. Local governments, fearing lower property taxes, restricted new construction. Fewer homes meant higher prices. Higher prices meant richer constituents. Political logic reinforced financial logic. Scarcity by design. In many developed countries, the real cost of land began to outpace the cost of building itself. A single square meter of urban ground could now represent more capital than the structure sitting on it. The economy flipped. Production mattered less than possession. Some historians argue that this was the precise moment capitalism ceased to expand outward and began feeding on itself. Instead of creating new wealth, it recycled old assets at higher prices. The market didn't reward innovation, it rewarded ownership. And the longer one held an asset, the more valuable it became, without any effort, without any creation. By the early 2000s, the numbers were surreal. In the United States, household debt surpassed national GDP. In Britain, Mortgage lending exceeded industrial output. In Canada and Australia, property values became the largest component of national wealth. Economies were no longer built on goods and services, but on the promise that tomorrow's buyer would always pay more. The system functioned until it didn't. When interest rates ticked upward or credit slowed, the illusion cracked. Every gain of the past decade had been borrowed from the future, and the future eventually sends a bill. The mechanism worked perfectly, which is precisely why it failed. When the system finally trembled, it did not explode, it imploded. Quietly, elegantly, with spreadsheets instead of smoke. The collapse was not just financial, it was generational. By 2008, the illusion of endless growth met its limit. Mortgage defaults in the United States triggered a global chain reaction. Banks that had treated home loans as risk-free assets discovered that the risk had only been hidden, not erased. The collapse of Lehman Brothers was not the cause, it was the symptom. The real failure was structural. The moment society realized that its wealth had been built on borrowed certainty. In 12 months, $8 trillion in U.S. housing value vanished. In Britain, prices fell by nearly 20%, in Spain by 30%. Whole neighborhoods became ghost suburbs. Millions lost their homes, and yet the deeper loss was invisible. Trust in the system itself. For decades, governments had promised that property was the safest path to stability. Now that promise looked like a mirage. The paradox was cruel. Those who had most believed in the dream, young families, first-time buyers, suffered the hardest blow. Those who had treated housing as investment recovered fastest. Bailouts protected banks, not borrowers. The market was too big to fail, but individuals were not. In Europe, austerity followed. In the United States, quantitative easing began, central banks buying debt to keep the system alive. The medicine resembled the disease, new money to repair the damage caused by too much money. Interest rates sank to historic lows. Liquidity returned, but the real economy lagged behind. And so the wheel turned again. Cheap credit re-entered the market. Investors, burned by stocks, returned to property. Housing became not a right, but a refuge, the only asset still considered real. Ownership shifted upward. Corporations and funds began buying entire neighborhoods, not to live in them, but to rent them back to the very people who could no longer buy. A generation was demoted from owners to tenants. The social consequences were profound. Homeownership rates, once the foundation of the middle class, began to fall. In the United States, they dropped from 69% in 2004 to near 63% a decade later. In major cities, the decline was sharper. The family home, once a tool for intergenerational security, turned into an inheritance lottery. Those who owned before the crash accumulated more when prices recovered. Those who didn't were priced out forever. Some economists called it asset bifurcation. Others called it housing feudalism. The meaning was the same. Wealth no longer flowed from work, but from position in time. If you bought early, you owned the ladder. If you were late, you paid the rent to those who climbed first. Governments responded with familiar tools: subsidies, tax breaks, low-interest policies. The same instruments that had inflated prices before. They treated affordability as a demand problem, not a supply problem. The result was predictable. Each solution raised prices further. And now imagine a world where stability is measured not by access, but by exclusion, where prosperity depends on the scarcity of homes, where the dream of ownership survives only because it's unreachable for most. That is not failure, it's design. The numbers confirm it. Since 2010, global real estate has become the single largest store of wealth, worth more than stocks, bonds, and gold combined. Over $330 trillion sits in land and buildings. Half of it is residential. Half of it, effectively, is us. The price of this system is not only economic, it is psychological, civic, cultural. When people stop believing they can own the ground they stand on, they detach from the future. They consume instead of invest, rent instead of build, move instead of belong. The social contract weakens, not through conflict, but through fatigue. The 2008 crash didn't end the dream of homeownership. It revealed what it had become, a mirror reflecting inequality back at itself. And perhaps the most sobering truth of all, every rescue of the system made it less rescuable. 15 years after the crash, the same system thrives, redesigned, digitized, renamed. But its essence remains unchanged. Only the vocabulary evolved. What was once called mortgage expansion is now financial innovation. What was once homeownership policy is now housing affordability strategy. The pattern repeats, perfectly disguised. Interest rates near zero created a new paradox: cheap money, expensive homes. Between 2010 and 2022, the price of an average home in advanced economies doubled. In Canada and New Zealand, it tripled. But wages rose only marginally. The invisible battery of debt charged again, this time through apps, algorithms, and investment funds. Homeownership, once an act of settlement, became a financial race. Investors used data-driven platforms to buy properties sight unseen. Hedge funds discovered they could securitize rent, transforming monthly payments into bond income. The same mechanism that once bundled mortgages now bundled tenants. The difference was only semantic. Some analysts call this the financialization of everyday life. Others call it neo-feudalism. Both describe a quiet inversion. The many work to sustain the assets of the few. The economic structure that once promised independence now produces dependence. The home, once the endpoint of effort, has become the instrument of it. And now imagine a world where a one-bedroom apartment trades like a stock, where landlords are algorithms, and where your rent contributes to quarterly earnings in a country you've never visited. That world already exists. It's just written in small font, in the footnotes of real estate trusts and pension portfolios. Technology did not democratize ownership. It digitized inequality. Platforms made it easier to buy, but not cheaper. Mortgage approval is automated, but the income required has doubled. The barrier remains, it's simply more efficient. Millennials and Gen Z, raised on the promise of flexibility, became the perfect tenants. They move often, spend freely, invest in experiences. A polite way of saying they have no fixed ground to stand on. Surveys in the United States and Europe show that fewer than 20% of adults under 35 believe they will ever own a home without inheritance. The middle class, once defined by property, now defines itself by survival. Governments, confronted by rising discontent, repeat familiar gestures: subsidies, grants, mortgage guarantees, all targeting the buyer, not the market. Each policy injects new money, lifting prices further. Economically, it's elegant. Politically, it's addictive. Socially, it's corrosive. The modern housing market no longer measures need, it measures tolerance, how much debt citizens can endure before breaking. And central banks, aware of the fragility, tread carefully. Every rate increase risks collapse. Every cut reignites inflation. Housing has become the nerve center of monetary policy, the one lever that cannot be pulled without consequence. Meanwhile, the generational divide has hardened into geography. Cities, once engines of opportunity, have become fortresses of capital. The young rent within them, the old own around them. The commuter belt of the 1970s has turned into the investment belt of today. Suburbs are no longer communities, they are balance sheets. And yet, the narrative persists. Media headlines still celebrate rising home values as economic good news. Politicians still frame ownership as virtue. Banks still describe lending as helping families achieve dreams. The language of stability conceals the logic of extraction. What we call prosperity is, in truth, debt with good PR. Some historians now draw a striking parallel. The modern housing market resembles medieval land tenure more than post-war capitalism. Ownership is concentrated, access is conditional, and mobility depends on rent. The difference is aesthetic: glass instead of stone, contracts instead of chains. But perhaps the deeper continuity is psychological. The belief that property equals safety, that land equals worth. Even as the ground beneath us becomes virtual, mortgage apps, digital deeds, tokenized assets, the emotion remains ancient. We still equate stability with ownership, even when ownership has been redefined beyond our reach. And the most uncomfortable realization, this is not collapse, it's adaptation. The system learned to survive its own crisis by shifting the burden forward to the next buyer, the next renter, the next generation. Housing remains the perfect asset because it cannot move, and because people must. Then it was called inflation. Today it's called appreciation. Then it was scarcity. Now it's exclusivity. History didn't change, only the label did. And if you've started to see the pattern, you're already inside the story. So what remains after 70 years of borrowed prosperity? A paradox. We built an economy where owning a home is the symbol of success and the proof that success is no longer possible for most. Our grandparents didn't buy homes because they were lucky. They bought them because the system was built to let them. Cheap credit, expanding wages, and governments that believed in the social value of stability. For them, a mortgage was a bridge. For us, it's a moat. The same policies that once lifted families now protect capital. The same tax breaks that built suburbs now preserve inequality. The same language, investment, security, ownership, still circulates, but its meaning has inverted. What was once a promise became a filter. And now imagine the quiet irony. Generations raised to believe that buying a home was an act of independence now find that renting is the only form of freedom left. No roots, no risk, no illusion. Just motion, the modern substitute for stability. Some say history repeats. It doesn't. It compounds. Each cycle builds interest on the last. Each belief carries a price. The story of home ownership didn't end. It simply changed owners.